Good afternoon, everybody, and welcome. We're just going to let our attendees come on in. There's a few more, and we'll get started. Welcome, everybody, to 2021. Hoping for all of us to have a better year than 2020. But for us, it started off with a little bit of excitement with the government coming out with what is known as the Consolidated Appropriations Act of 2021. And there's lots of goodies in this bill. And so we're going to share with you some of the things that are going to help you understand what's in here and hopefully be able to apply it to your business. So before we get started, I just want to let you know that we're doing our best to share with you the information that we're aware of at this point in time. And if there's anything that we've overlooked or we're not clear, we just make sure, please ask that you check in with us, make sure you've got all the details before you apply anything you learn here. And we are recording this, so you'll have the ability to go back and rewatch it. And just for question and answer purposes, you should find that there is a Q&A place for you to ask us questions. And we have saved plenty of time at the end of our presentation for those questions. Okay, so I am David Goodman, and I am Managing Director of LB Goodman and Company. And my sidekick and the guy who knows a lot more about this stuff than I do sometimes is Sean Brahini. And together we've been presenting a whole bunch of webinars for you since the pandemic began. And we will continue to do so and continue to bring clarity to you in terms of how you can apply what's happening out there in the business. So we just have a little slide here about be kind to your CPA. The CARES Act, which came out last March, was over 800 pages. There were 24 interim rules that came out, which were over 100 pages. There were 77 SBA frequently asked questions, which was 25 more pages. And then they came out with the Consolidated Appropriations Act of 2021, which is 5,600 pages. So there's a lot of reading that we have to do, and we'll probably continue to do as we get clarity on the information that's been shared with us in the Act. So Congress passed this Act on December 22nd. It was signed by the President on December 27th, and there are provisions in the Act that require various different government agencies to have processes in place within certain periods of time. We'll share with you all of that as we move forward. So we're going to kick this off with Sean talking to you about major changes that happened in the employee retention credit. And listen closely, because there's going to be a lot of things here that should be able to help you possibly figure out if you can save some money. So Sean, take it away.
All right, good afternoon, everyone. Like David said, there are some big major changes that came about through the CAA. First, probably the biggest one we want to talk about is going to be the employee retention credit. All right. So first, just a little refresher on the origins of this credit. It was originally created as a part of the CARES Act. It provided employers with a refundable credit of up to 50% of qualified wages that were paid to employees between March 13th, 2020 and December 31st of that same year. It could be used to offset federal payroll taxes. That includes your federal withholding, employer's share of Social Security Medicare tax, but it excludes your federal unemployment tax. And most importantly, at that time, it was not available to any borrowers of PPP loans. So we're going to refer you to any of our previous webinars on the CARES Act and any other COVID-19 legislation for more details on that. We will be sharing a little bit later on. So first, some relevant changes that were made to this credit as a part of the CAA. We're going to review the limitations on the credit. We're going to review changes in the eligibility for PPP borrowers. There were some changes to the large employer threshold. We're going to discuss changes that were made to the gross receipts test that determines your time period of calculation. We're going to review the availability of the credit, as well as any necessary tax planning that has come up as a result of these changes. So first, changes made to the limitations of the credit. Now, the maximum wages that are eligible for consideration within the credit calculation were changed from a maximum of 50% of qualified wages. Now, this is up to a $10,000 cap on wages per individual employee, to 70% of qualified wages with a $10,000 quarterly cap. Now, it's important to remember that this change is not retroactive. This change only applies as of January 1st of 2021. For any credit calculations for the 2020 tax year, the original 50% limitation applies. All right, the most important change here has to do with the eligibility of your PPP borrowers. They are now eligible to take this credit, but they will need to make an election to exclude qualified wages from either payroll costs that are eligible for forgiveness under the PPP loan, or they need to exclude them from the calculation of this credit. So based on early guidance, again, we have nothing definitive or final on this. It is possible that in the event that a PPP loan is not forgiven, the qualified wages that you're using for one may be able to revert back to usage for the purposes of this credit calculation. So going back to the tax planning, it may be possible to allocate some of those qualified wages or other expenses that qualify for forgiveness between the two. Now, this change is retroactive to the effective date of the CARES Act back in March. All right, some changes to the large employer threshold. Now, under the CARES Act, there was an additional restriction for employers that had more than 100 full-time employees. This credit was only available in that case with respect to wages that were paid to employees that weren't providing services. So, in other words, you had to be paying these people not to work. The CAA has increased that threshold to employers with more than 500 employees, so it becomes a little bit easier to fall under. So next, we want to talk about some changes to the gross receipts test. This really is the driver of this calculation, and it's going to determine whether or not you will have any eligible wages for it. So under the CARES Act, an employer qualified for the credit under the gross receipts test, starting with the first calendar quarter for which gross receipts were less than 50% of the same quarter in 2019. Now, that's when the clock started. The clock ended at the end of the first subsequent quarter in which gross receipts were more than 80% of that same quarter in 2019. Now, before we move on, we want to go through a really brief example on this. Now, below you're going to see a table with some examples of employee wages for the second quarter of 2020. Now, in this example, the business is entirely shut down by government orders, so no one's working. They're being paid to not work. There is a fewer than 100 full-time employees during the same quarter in 2019. So again, these are the wages that we have paid in the second quarter. Now, based on the information we just went through, you may assume that seeing the total wages there, your total credit is $16,500, but it is close, but no cigar. Okay, keep in mind that there is a per employee cap of $10,000 in wages. So you would take half of employee A, half of employee B, and half of employee C. That's going to total a maximum credit in this example of about $14,000. All right. So now what changed under the CAA in terms of this calculation? Again, this is only effective as of January 1st of this year. The first measurement quarter, which we'll refer to it as, has been revised for gross receipts that are less than 80% of the threshold as compared to the same quarter in 2019. The second measurement quarter is remaining the same as it was under the CARES Act. Another big change, employers may now elect to apply the gross receipts test based on those from a prior calendar quarter instead of prior year's quarter. And this credit is now available in 2021 to any employers that were not in existence in 2019. This was not available under the CARES Act. All right, availability of the credit. So it originally had been available through December 31st of 2020. Under the CAA, it is now available through June 30th of this year. Now, only for employers that have fewer than 500 employees, they may elect for any calendar quarter to receive an advance payment of this credit for that quarter that cannot exceed 70% of the average quarterly wages that were paid in 2019. This can be retroactively claimed for 2020. All right, now, like we said, there were some tax planning opportunities that came up as a result of these changes. First and foremost, and we cannot stress this enough, please talk to and consult with your tax advisors before making any decisions on this, and you will want to do so quickly. Now that both of these are on the table, you need to review your specific scenario as to what combination is really going to create the biggest benefit for you tax-wise. Again, this is time sensitive. You're going to need to make a determination of whether or not you had an eligible quarter in 2020 based on the examples and the information we just shared. And you'll also need to quantify what those qualified wages are. So it's time sensitive. Please be in touch with your tax advisors. All right, next big issue, next big change we want to talk about, and I'm sure something most of us care about, is the second round of stimulus payments or recovery rebates that come with this act. So again, the big questions here, I assume, is going to be boiled down to three main ones. How much are we going to get? How is it going to be calculated? When are we going to get it? And we're going to go through those. So first, how much are we going to get here? Now, this second round has been reduced from the original $1,200 per individual to $600 per individual. Now, there are going to be additional $600 rebates available for children, not adult dependents. And as a change from the first round, there is going to be no cap on household size. How is it going to be calculated? It's going to be calculated similar to what we saw in the first round. It's going to be based on your 2019 gross income. Now, phase outs for this is when these payments start to reduce, is going to begin at $75,000 for individual filers, $112,500 for head of household filers, and $150,000 for joint filers. Now, these payments are going to completely phase out and completely disappear at $87,000 for individuals and $174,000 for joint filers. Again, this is going to be provided that there are no qualifying children in those scenarios. If there are, then obviously you're still going to get something. Now, going back to the first round of payments that most of us did receive, those will be reconciled with your 2020 filings. That's going to happen in the case where you received less than you should have, or you weren't originally eligible based on your 2019 income. When are we going to get it? So first, a brief timeline that David briefly alluded to at the beginning. These were approved by Congress on December 21st. Payments via direct deposit were automatically began on December 29th, and paper checks were scheduled to be mailed beginning on the 30th of December. Now, in this case, this means that most of us may have already received these. All right, the next change we want to talk about are changes to unemployment compensation. So first, the CAA has provided an additional $286 billion in unemployment relief. It reinstates enhanced federal unemployment insurance. It's going to provide an additional $300 per week for all workers receiving these benefits through March 14th of 21. It also expands and extends the Pandemic Unemployment Assistance, or PUA program, through that same date. Coverage under that PUA program has also been extended to self-employed individuals, gig workers, any others in non-traditional employment. It's going to extend the Pandemic Emergency Unemployment Compensation Program through that March 14th date, and it's going to increase the max number of weeks an individual may claim benefits. Now, again, those are your normal state benefits plus the additional federal subsidy, to a total of 50 weeks. All right, some other legislative changes that were made that we want to go through. We're going to take a look at the extension of paid sick and family leave tax credits. We're going to take a look at the increased above the line charitable contribution deduction. We're going to take a look at the corrected 30-year cost recovery period. We're going to take a look at deferral of employee side payroll taxes, the deduction of unreimbursed medical expenses, the energy efficient commercial buildings deduction, as well as some other smaller miscellaneous permanent and temporary changes. So first, the extension of paid sick and family leave tax credits. Now, under the CAA, these benefits have been extended from the end of 2020 through March 31st of this year. Now, this is temporary. It's only been extended for 5 years. So some changes to the charitable contribution deductions. As I just described, under the CAA, taxpayers that do not itemize are now allowed to take an above the line deduction for contributions of up to $300, and that goes up to $600 for joint filers. Now, keep in mind, these need to be made to certain public 501c3 charities. And it's also important to remember, take this into account when you're gathering this data. The penalty for overstatement of items such as these has been increased from 20% to 50%, so be very careful. On another note, the limitations on deductions for certain cash contributions, they've been loosened a little bit for 2020. Now, that original 60% of AGI limitation we saw with the CARES Act has been suspended, and now we're looking at 100% of AGI deduction that you are available to take. All right, next we want to discuss the correction to the 30-year cost recovery period. So first, a real property trade or business may now elect out of the business interest expense limitation that had originally been put in place by the Tax Cuts and Jobs Act. Now, if this election is made, that business is going to be required to use a longer cost recovery method or period of depreciation under what they call the alternative depreciation system. Now, it's important to see that the CAA is correcting a drafting error so that the 30-year period, instead of a 40-year period, can be used for all residential property, regardless of when it was placed into service. All right, next, deferral of employee side payroll taxes. Now, this was originally put in place by a memo that was issued by President Trump in August. Now, under that memo, employees were permitted to defer the employee portion of certain payroll taxes for any employee that had pre-tax wages, and this is on a biweekly pay period basis, that were less than $4,000 between September 1st, 2020 and December 31st, 2020. Now, these deferred taxes were originally scheduled to be withheld from employee wages and paid between January 1st of this year and April 30th of this year. The CAA has extended that payment deadline to December 31st of this year. So if this is something you've taken advantage of, you have some more time. Now, it's important to remember that after that December 31st date, interest and penalties will begin to accrue. So it's important that you want to have all of that paid in by that point. All right, now some other smaller miscellaneous permanent and temporary extensions. So the first one we want to discuss, unreimbursed medical expenses. Now, this had originally been scheduled to be changed to a 10% threshold in 2021. That 7.5% floor has now been made permanent. What also been made permanent is the deduction for energy efficient commercial buildings, otherwise known as Section 179D deduction. Another temporary change, energy efficient home credit that was extended for 1 year. The work opportunity tax credit was extended for 5 years. The exclusion from gross income of a discharge of qualified principal residence indebtedness, basically a home mortgage that on your principal residence that has been forgiven, has been extended, and those numbers have been lowered to a maximum of $750,000 for joint filers and $375,000 for individual filers. Now, another temporary change includes the exclusion for certain employer payments of student loans. That's been extended for 5 years. And lastly, mortgage insurance premiums that are able to be deducted as qualified residence interest, that's been extended for another year. Now, next, we're going to go back to David, who's going to go through some of the more important changes of the Act. David?
Thank you, Sean. That was great. And I hope that people were able to absorb what you shared because the employee retention credit is important. But I hope you understand that it only applies to those businesses that were forced to shut down by the government or businesses that lost at least, what was it, 50%, Sean, of the revenue in any quarter? Or 80% now? How does that work?
So for 2020, the threshold is 50%. Going into 2021, it's going to be 70%.
Okay, great. So that's important for you to know. So the employee retention credit applies when you have those situations, but it is a very a significant credit and would probably wind up applying to most businesses that closed at the very beginning of the pandemic. And we're looking for guidance right now in terms of how to apply for this credit, especially retroactively. So thanks for that. I also want to share with you that at around 11:30 this morning, the state of New Jersey released information that has stated that there was supposed to be an increase in unemployment payroll taxes for employees and specifically for employers to help fund the state unemployment fund. That increase has now been tabled. They passed a new resolution that said there is going to be no increase. So for those of you who were anticipating that increase in 2021 beginning July 1st, that has now been put on the table. So we won't have to be worrying about those increases. So let me talk to you about something that was good in this new Consolidated Appropriations Act that has to do with business meals. So on page 4946 of the CAA, you will find that business meals are going to be 100% deductible. So in the past, we've been looking at business meals being 50% deductible. They have not brought in anything regarding entertainment. So this is strictly business meals. They start January 1st of 2021. Ending right now, December 31st of 2023, 100% deduction for business meals when they are provided by a restaurant. So obviously it doesn't say that you have to eat in, it just says provided by a restaurant. But we need some clarification as to exactly what a restaurant is going to be. So we're waiting for that and hopefully we'll have that soon. So probably a lot of you have been waiting for this part, and this is really something that was really great that happened, and this is the updates to the PPP loans. So first I want to talk about the updates to the original PPP loans. What has changed about them? And the biggest change that we have is found on page 2004 of the bill, which says no amount shall be included in gross income by reason of forgiveness, and no deduction shall be denied. Basically saying the PPP loans are not taxable. And this is also going to apply to PPP2 or the second draw on PPP loans, which I'll talk about in a little bit. So this has really been helpful. And 20 minutes before we started our webinar, the IRS released Revenue Ruling 21-2, that states that they are in agreement now with what Treasury has said, that PPP loans are not taxable, and they have made obsolete their previous revenue rulings, which kind of creates a little problem now. So first of all, is this really free? And the answer is, if you're a sole proprietor or a single member LLC taxed as a sole proprietor, you're probably not going to have any issues with PPP loans not being taxable right now. However, what if you're an S corporation or a partnership? So PPP is considered tax exempt income. It says that in the bill, which will increase owner basis. That's how tax exempt income is treated. However, when is it going to be considered tax exempt income? Is it considered to be tax exempt now, or when it's forgiven? And if it's when it's forgiven, then in 2020 there could be tax issues for owners who have taken distributions in excess of their basis. So a lot of businesses we've been working with have found that they've had excess cash and looking to make distributions to owners through S corporations and partnerships, and have found that it's quite possible that these distributions might be subject to tax. Now making the prior IRS revenue rulings obsolete, this really creates some confusion, and we do need some clarity now as to the timing of when a PPP loan is considered to be tax exempt income, when it's forgiven or right now in 2020. So we'll be updating everybody on that, and hopefully we'll be able to let you know that these are not going to be taxable if you took distributions. Many of you also probably applied for the Emergency Injury Disaster Loan Grant. That was the $1,000 grant per employee up to $10,000. Was originally supposed to reduce your PPP forgiveness. So if you borrowed $100,000, or if you received $100,000 for PPP loans, and you applied for forgiveness but had received a $10,000 EIDL grant, only $90,000 of your PPP loan would be forgiven. The other $10,000 would have to be repaid. Well, guess what? The CAA says they're treated the same way as the PPP. So your EIDL grant is not going to be taxable, as well as now your PPP loans that are given forgiveness. Okay, so there's been some changes now in forgiveness that I think you should be aware of too. We encouraged our clients to wait to file for forgiveness. And for those clients with loans up to $150,000, the wait was worth it, because there's hopefully going to be a new form that, according to the CAA, requires that it be one-page application. You certify that you're in compliance with the PPP spending rules. You provide them with some other basic information, and you sign off and submit, and you should be granted forgiveness. Now, we are going to tell you that you must save this information supporting the forgiveness, supporting the claims that you make in this application for 4 years, because the government can come back and audit you to make sure that you were in compliance. So make sure that you keep that information for 4 years to support your claims on this very simplified application. That's a really great thing to have. Now, we also suggested to keep forgiveness applications as simple as possible by using all of your PPP money for payroll during the 8 or 24-week covered period. This still holds true for loans over $150,000. We're still recommending that you try and support your PPP spending exclusively with payroll. However, for loans over $150,000, you're still going to be required to provide support to the bank to submit, to make sure that you have supported with documentation your PPP loans spending. However, you now might want to consider, if you are eligible for the employee retention credit, of possibly going back and looking at some of the other qualified expenses for PPP spending, like rent or utility or interest on loans, to be able to maybe take advantage of moving some of that payroll into qualifying for the employee retention credit. So that's something that we're available to help you with, and you can certainly reach out to the accountant that you work with at our firm, and they can certainly help you to see if you're eligible for the employee retention credit and how to try and maximize it with your PPP funds. So the SBA has 10 days from enactment to provide the updated forgiveness process. Guess what? That's today. And we got notification last night that tonight we expect a lot of that clarification to come out. So it's going to be a long night for Sean and I to try and digest whatever comes out. And we hope that we'll have information available not only on our website, but also through our constant contact emails, and get you that information to help you to make the process of forgiveness easier. Now let's talk about the PPP second draw. So the CAA, you love that alphabet soup, right? So the CAA, the Consolidated Appropriations Act, allows for a second draw for the Paycheck Protection Program, PPP. But there's some changes. You're going to find this, first of all, on page 2064 of the bill. And now it says that the second draw, or PPP2, is for companies that have no more than 300 employees. That's by head count. That's not by full-time equivalents. And that's down from 500 employees for the original PPP. You also have to be following the PPP spending rules on the first draw. That does not mean that you applied for forgiveness, but it just means that you have to have spent your money with the original PPP appropriately in compliance with the rules. Here's something interesting that's changed with the PPP2. You must have a 25% or more reduction in gross receipts from one quarter of 2020 compared to the same quarter of 2019. 25% reduction in gross receipts. So many businesses that may have been closed in March, April, May, even June, those organizations, a lot of dental practices that we work with, will probably be eligible for the second draw. However, we're not sure exactly what gross receipts mean, but we probably can figure for our dental clients that they will qualify. So we'll get some clarification, maybe even tonight, on what gross receipts are. The maximum loan is now $2 million for the second draw. The first draw was $10 million maximum. There is no date yet for restoring the full-time equivalent safe harbor. If you remember, with the original PPP, you had to have the same number of employees on the payroll, or full-time equivalent employees on the payroll, as of February 15th, 2020, and of the last day of your 24-week or 8-week covered period. So there is no provision for that yet, but we're not sure. There may not be any. We'll have to see what happens. Remember, the PPP is the Paycheck Protection Program, so we're still looking at keeping people employed, or at least receiving a paycheck, even if they're not working. So the same calculation for what the loan qualification is it's 2.5 times your average 2019 payroll. So that's the same rule that applies. There are different rules for seasonal businesses and different rules for businesses that were that started in 2020. There is one difference though, and that is for businesses that have an NIA CS code. That's a business classification code that the US uses, that begin with the number 72. You're actually eligible for 3.5 times your average 2019 payroll. These are businesses that are in what's classified as accommodation and food services. So included in this category are restaurants, both formal and casual dining, as well as RV parks, I don't know why, restaurants, hotels, hospitality. That's all businesses that have an NIA CS code of 72. Um, Another twist here is that loans over $150,000 must show financial need. So you're going to have to prove that you need the money if your loan is going to be greater than 150,000. Now, PPP2 spending has changed a little bit too. What hasn't changed though is at least 60% of the PPP2 must be used for payroll and payroll related costs. And payroll related costs have expanded. They included state taxes that were paid by the employer on employee wages, and it included health insurance benefits, and now also includes group term life, disability, vision, and dental benefits paid by the employer. So that's additional payroll expenses that can be used with PPP funds. But there are additional spending categories as well. One of them is really interesting, and this is business software or cloud computing to facilitate operations. So those organizations that had to move their employees home and had to make expenditures to provide technology so that they could work from home, these types of expenses will now be eligible for PPP2 spending. In addition, supplier costs for goods for operations that were pursuant to a contract prior to the covered period, in other words, prior to the receipt of PPP loans. If you had a commitment to buy, those spending categories are now eligible also for PPP funds. And this is a really good one and a smart one, I believe, is that employee protection costs to comply with the CDC, OSHA, and HHS are also now eligible for PPP2 expenses. So there's been some little changes, but the basics, the bones of the PPP still remain very similar. So I want to thank you all for joining us today, and we are going to answer your questions. Sean, we have 2 questions right now. I don't know if you can see them. The first one is can we share the presentation of our handouts? And what we'll do is on our website, we will make the handout available for you to download. So give us a day or 2 and we'll have all that information up for you, as long as also with any updates that we are able to share with you based on guidance that we get this evening. Sean, our second question has to do with PPP forgiveness, payroll, what is included, Social Security, Medicare, unemployment, disability, health insurance, other benefits. PPP does not include, or the qualified payroll expenses for PPP does not include any federal taxes. So it does not include Social Security or Medicare tax. It does include state unemployment taxes that are paid by the employer. So that would include unemployment and disability insurance. Yes, it does include health insurance benefits, again, paid by the employer. And it does include the other benefits that I mentioned, which include group term health insurance, group term life insurance, disability insurance, dental, and vision paid by the employer. And it also includes retirement plan contributions. Now, remember that employee maximum is still $100,000. So based on an employee earning $100,000 a year, there are limitations. Our figuring has come up with, I think it's $1,923 a week is the maximum that can be compensated to any employee. So you have to also consider these extra payroll costs when you're looking at what an employee can receive on a weekly basis. So we have another question is, when can you apply for the PPP2? And when can we expect funding? That's a great question. The Act actually states that PPP2 money should be made available within 10 days. So that today is the 10th day. And the expectation is that we're going to have guidance tonight as to when applications for PPP money will be available. Now, just so you know, there's $234 billion assigned to PPP funds. So the expectation is that there's going to be money left over for PPP2 as compared to how much money was needed under the original PPP draws. But yet we still want to make sure that everybody gets their applications in. I'm pleased to state that every single one of our clients that applied for PPP funding did receive it. Those who applied for the provider relief funds, which were available for medical professionals, those who applied got their funds as well. There is going to be another provider relief fund. We don't have details on that yet, but we'll share them when we can. So if you'd like to join our mailing list, you can see the email on the slide. You can email Patricia at lbgcpas.com, and she will make sure that she includes you on our constant contacts that go out and any updates or any webinars that we may have for you. And thank you so much, and look forward to our next update as things change. And of course, depending on what happens with the elections in Georgia, there could very well be some new tax laws that we'll be sharing with you later on. So on behalf of Sean, myself, and our team at LB Goodman and Company, thanks so much for joining us. Have a great day.